Shares in Parex Resources taking a major hit. Calgary-based oil and gas company cut its production forecast after disappointing results at wells in Colombia. And the chief financial officer is leaving. We're joined by Bloomberg's Stephanie Hughes. Stephanie, give us the update here on Parex, please.
For sure, Andy. Yeah, like you mentioned, there's a lot going on with Parex, and that caused shares to fall as much as 34% today. 34%. That's the biggest intraday drop on record, and it brought the stock price down to 2020 levels. Like you flagged, the oil and gas company reduced its 2024 outlook, its production outlook, to a range of 48,000 to 50,000 barrels of oil a day. That's below analyst estimates. The company flagged that its weakness, or lower than expected results coming out of one of its wells in Colombia. And to make matters more confusing or uncertain, the CFO also resigned. So this prompted an analyst downgrade at RBC, who said that to a sector perform rating, calling the operational update disappointing. Not only that, but Mackey Research Capital also downgraded the company to a hold rating. So a lot of moving parts in this story, but it seems like analysts and traders alike are very dramatically reacting today, Andy.
And give us the latest on CIBC. That stock hitting a multi-year high today. So a lot of the banks actually delighting investors. Royal Bank's at another new record. BMO still in the penalty box. But remind us what CIBC reported, please.
Sure thing. So CIBC was the last of the big six banks to report this earnings season. Those shares are up 6.4%, as much as 6.4% today. That's the biggest intraday gain since late May, and it brought the stock to its highest level in over 2 years. That's because the earnings of $1.93 per share easily beat analyst estimates after the company set aside less cash for loans potentially going sour, and it reported some strong revenue growth across its core segments. So CIBC's provision for credit losses came in well below what analysts were expecting, and on this measure, it was also the bank's best quarter in over a year. The bank says the worst of the U.S. Commercial real estate woes are behind it, and it also reduced its exposure to this segment. The head of risk management also noted that higher unemployment rate will be a headwind for the credit outlook just in general, but with anticipated rate cuts and the rate cuts that we've already seen, that should alleviate some pressure there. Its core banking segments were also quite strong. The core Canadian banking segment saw a 26% year-over-year gain in profit. And the report got some high praise from analysts, including Jefferies analyst John Aiken, who said it was simply an impressive quarter, and he expects that the strength should bolster further momentum in the valuation. And we're seeing a hint of that today, Andy.
Maybe we could put up a 5-year chart for the TSX banking index, because I just noticed something interesting here, Stephanie. Over the past 5 years, the banking index, including dividends, has given you a return of 66%. And that is almost exactly the same as the broad TSX. So this is the return, this is the performance of the banking index without dividends. And of course, that's very much, how did you like the play, Mrs. Lincoln? The dividends are the reason to buy these stocks, but sorry, bad taste. But TSX Composite, it's up. It's actually up 42% in 5 years, but because the dividends are less, the return from the banking index is the same. So you could have saved yourself trouble and just owned the banks all that time. You would have had the same return. But as you know, through 2021, a lot of 2022, the banks actually underperformed because people were worried about the housing market maybe turning down and people's mortgages going offside.
Absolutely, and then loan growth slowing down with high rates was also an issue there. And yeah, it's been a very interesting couple of years for the banks there, Andy, as you pointed out.
Stephanie, we'd better jump. Always great hearing from you. Thank you very much. Stephanie Hughes of Bloomberg.